Okay, good morning, everyone. I want to thank you all for joining us for today's call with Insurance Network America, featuring one of our premier partners, Dan Hudgens, who is the Regional Vice President with Protective Life. My name is Tom Vukovic. I head up the Financial Products Division with Insurance Network America. And I am very excited about today's speaker and topic, since I am absolutely certain you will come away from today's call with some very usable concepts to help you close more life business, to help you mind your existing book of business, and help you to create some opportunities with your clients. Dan does a terrific job of bringing usable ideas. He's one of the best I've seen at doing this. So again, I want to thank you all for joining our call. See a lot of our existing agents on this call today. I want to thank you all for your continued business. A lot of new names as well, and I want to welcome you all. I want to encourage you to give us an opportunity to earn your business. Find out why we are different. If you're ready to contract with a field marketing organization that will make you feel special, will put you first, your clients first, give us an opportunity to earn your business. Here's our 800 number. Write this down, 800-456-7999. I want to encourage you, if you have questions, to please enter those into the question box on GoToWebinar. We'll do our best to get to your questions today. We're going to try our very best to keep this to 30 minutes to allow you to get back to your business. So with that, if we do not get to your questions, please enter them in the box. We will be following up with you after today's call to make sure you have everything you need. If you have any questions, we'll address those at that time. But I want to encourage you too, if you have some specific clients that come to mind on today's call, don't wait. Call us. Reach out to us if you have something urgent you want to discuss and go deeper on. We've got some terrific case managers here that we can run all kinds of scenarios for you. So I'm not going to talk any further. I want to turn it over to our speaker today, Dan Hudgens, Regional Vice President with Protective Life. Dan, thank you for joining us today.
Thanks, Tom. Appreciate it. Thank you, everybody, for joining. I appreciate you taking time out. Last month, I'm going to do some very specific ideas today. I think one of the most important things that get out of today's call, I want you to take away from the thing. Number one, a little bit of understanding if you're not familiar with flexibility are specifically term solutions we're talking about.
Hey, Dan. Dan, I'm sorry to interrupt you. I'm having a little trouble with you breaking up on the call. I'm not sure if I believe a few other people have mentioned that. So let's give it just a second.
Let me try this here. Okay, is that any better at all there?
That is terrific. Much better.
Okay, perfect. All right, so basically, all right, if there's any other issues, let me know. But just kind of to repeat for those of you who didn't grab that, there's three things I really want you to take away from this call. Number one is a little more understanding of Protective Life, kind of as a company. A little more of an understanding of the flexibility of our term solution, which we call Custom Choice UL. And then also the specific sales ideas that we're going to give you today. And I'm going to give you three of them that I think you'll be able to implement immediately with your prospects and your clients that you currently have. It's not something you're going to have to actually go out and find new clients. So with that, let's go ahead and get started. I want to give you a little bit of an overview of what we're going to be talking about today. I'll give you just a real brief industry update because there's a lot of things going on in the industry. We'll just mention why that's important for our conversation today. Then I'm going to give you a little bit of an overview of our Custom Choice UL, which is our term solution, our short-term death benefit product. And for those of you who know it, that's fantastic. I meet producers every day who say, yeah, I've sold that product, it's great. Then we start talking about some of the flexibility and they say, I had no idea. So we're going to talk about a couple of things that might be unique about it, and then we're going to dive into the sales ideas. And like I said, I want you to come away with really 2 to 3 very specific ideas that I think you can immediately start implementing today as you meet with prospects and clients. We'll give you those action items. So a little bit about the industry. I think for any of you who've been in this business long enough, and especially in the last 2 years, there's been a lot of change that we've seen. There's been carriers that have been exiting the market. Products have been changed. We've seen carriers that have changed philosophies. And really what we're selling our clients and our customers is always shifting. And so one of the things that we'll talk about today is the importance of reviewing policies with your clients, even policies that were written recently, just to make sure that they are exactly as we had intended them when we sold them. So with this change in the industry and kind of the chaos that we see comes a lot of opportunity for the producer, for you to be able to sit down with clients and say, look, let's review what you have. Let's make sure it's still what is best for you. And when it comes to term insurance, we usually say, oh yeah, if you got a 10-year term, let's circle back and review it in year 9, or let's circle back in year 19 of a 20-year term. And we're going to talk today about why that's probably the wrong philosophy and where you can take advantage of all of these changes in the market to continually review policies with your clients. Protective has been around over 100 years, and for any of you who have known us, we've been around a long time. We don't have a stadium that's named after us, and we don't do television commercials, but we have made a lot of acquisitions. So companies that you might have been familiar with in the past, like West Coast Life and Empire General, those are a lot of the acquisitions that we've made over the years. A couple of years ago, we acquired the Mutual of New York block from AXA, and that was a really large acquisition. Last year, we reinsured a block of Genworth business. So that's part of our business model, is acquiring blocks of business, but we've remained consistent, competitive, and reliable over the years. We're very financially sound. We were actually acquired a couple of years ago by Dai-ichi Life. The acquisition actually went through last year. And what that did for us is that made us even a stronger company. If you look at our risk-based capital, these numbers are a little bit dated because the Japanese calendar for fiscal year for Dai-ichi actually runs through the first quarter of this year. So we don't have the final numbers yet. So the numbers totaling through 2014. But our current risk-based capital from Protective as far as a life insurance company is right around 562%. Most people, most regulators like that to be 300 to 400%, so very strong. That just shows our ability to have money on hand to pay claims. Excess capital is always a nice thing when you need to make some in philosophy. We're also very much stronger as part of the acquisition. So as a company right now, Protective and Dai-ichi, the combined company, we're sitting on about number 13 as far as global life insurance companies by assets. So you can see a lot of the people on the screen there, the big names, the AXA, the MetLife, Prudential. We're now a player. We're now in the top 13 and looking to move up to be a top 5 life insurance carrier in the world by year 2020. So that's a little bit about Protective. Our financials, we're very, very much interested in simplifying the process for you, the producer, as well as for the client. And really what you sell matters. It's not just a product. So when we talk about that, it's also how you sell it matters as well. And typically people think about term insurance and they say, well, here you go, here's your death benefit, and here's the length of your term, and that's it. So whoever's cheapest, great, we'll just show that. But I think you'll see today as we talk about this, why there's a little bit more consideration that should be given to that product line and how that can help you as a producer provide better solutions for your clients. Typical sales approaches kind of have led us astray. So when we talk about spreadsheet analysis, especially with term, that's a big one. A lot of people will say, well, let me just run a spreadsheet. We'll pick the top 10 insurance companies, see what their pricing is, and go from there. Focuses on cost. And really that's what you're training the consumer to value is, okay, what's the lowest cost? If everything else is equal, which we'll show today that it's not, focusing on cost can be kind of dangerous. We also often just sell the policy. Here's what it does. Here's all the benefits of it. And we really forget the client and what their needs are and what matters to them, what's important to them. And cost is always important, but it shouldn't be necessarily the only thing. And then a lot of times we miss the middle market. So we run the term quotes and we get the people that say, hey, I just need this simple basic term quote. And then we try and we go after the big business owner policies. We go after the big estate planning policies. And so there's a lot of that stuff in the middle that I think we'll talk about today that's really advantageous for you. So why should you sell more than just the cost and more than just the spreadsheet? Well, it helps you stand out, helps you show that there's something different about you and the process that you implement. But it also grows your referral business, and we'll talk about that because I think not only does it improve retention when your clients are comfortable with what you're providing to them, but if you're providing options that will provide future potential sales, that's kind of an inherent referral business for you. And it really just goes beyond the spreadsheet. So you can drive some higher yield sales and you can show some products that aren't necessarily more expensive, but might generate some additional business for you. It really only takes about 5 minutes. So we'll talk really specifically about what those are, and let's kind of get into that here as far as the typical term sale. And I think a lot of you will agree with what this is, but normally we take a $500,000 face amount for, this is specifically a female 45. We're going to look at a 15-year term at preferred. And normally how it goes is you have a locked-in 15-year period where your premium is level and your death benefit is level. And if you look at that cost per thousand, not a lot of people focus on that, but we're going to kind of emphasize that because I think that's important to look at. It's about $1.10 per thousand. But what happens in year 16? Well, we see that premium go through the roof. And in this specific case, that's a 1,500% increase in premium, which means that cost of insurance goes up to about $17.79. And then each year after that, it continues with that annual renewable term, and the premium goes up, and that cost per thousand goes up. So we went from providing something to a client that was about $1.10 per thousand, that now 5 years after its level period ended, they're about $25. Now, in a lot of scenarios, this isn't necessarily what happens because a client will let that lapse. And that's usually what happens, right? There's 3 typical things that happen at the end of a term policy. One is the ART rate. So you can continue it and you can see what we just saw on that slide, which is every year that premium goes up and that cost per thousand goes up. Or they can just stop paying it and just let it go. And this is what a lot of people do if the true need has gone away. But a lot of times we see that some of that need remains after the level period. Or they can just start over and just say, okay, now I'm going to re-qualify medically and I'm going to go after a new term policy or maybe a permanent policy. And the challenges you have there is whether or not they're healthy. Now they're a certain number of years older, so the cost goes up. Sometimes there might have been a conversion privilege, but usually at the end of the term policy that ends. And they don't have a conversion privilege. So let's talk about protective and why there's a little bit of a difference there. And when I say there's a lot of difference there. And it really speaks to what if life happens. What you necessarily sell something today might not be exactly what they need 5 years from now or 10 years from now because life happens. So here's what Protective's policy does. And if you've sold our policy, hopefully this makes sense, but I want to emphasize the differences. So you still have the 15 years locked in at the level premium, level death benefit. This pricing, and this is the same client we just saw. Ours is a little bit less expensive, but as you know, term can fluctuate. So in this case, we're a little bit less expensive. But look what happens in year 16. We keep that premium level, and then we decide to decrease the face amount each year after the level benefit. So as a producer, you're discussing with your client the need and the length of that need. But as we stated, that $500,000 need might not be completely eliminated after year 15. They might have a residual need. Well, if they do, they can keep paying that $442 of premium, and they can keep, in this case, year 16, $274,000 of death benefit. And then the very next year, it goes down to $246, but they keep that same level premium. But look at the actual cost per thousand, not a significant increase. $1.61 in year 16, then $1.80, then $2. The far cry from the $25 that we were seeing on that previous example of term. So that's a big difference when we talk about term. It's just term, you get your death benefit, you get your price, and that's it. Not the case with Protective's custom choice, which is actually a universal life. I've mentioned that it's custom choice UL. So what are some of the things we consider here? And what we'll do is we'll talk about some of the highlights, and then we'll get into the sales ideas here. Traditional term, we have the rising premium after the level period. With ours, the level premium stays the same after the death benefit, and the death benefit starts to decrease. Most term, there's limited conversion. With ours, it's actually a 20-year or age 70, whichever is first, conversion. Gives a lot of flexibility. Even on that 15-year term that we just talked about, they could convert in year 16 or 17 or 18 at the lower death benefit without any evidence of insurance. Most term policies will have a 30-day grace period. Ours has a 61-day grace period. Again, that keeps you tied to the client longer, and they call you in day 50 and say, oh no, I missed my payment, what are my options? Well, we're still within our grace period, and they don't need to fill out the reinstatement form. We don't take any kind of a policy fee out when calculating your commission, which might result in some additional commission for you. And we have some options to stream the death benefit as an income, which might reduce premium, might provide a better flexible solution for whoever the owner is trying to leave the benefit to. And we can talk about more of those separately. So let's get into the sales ideas. And this is where I want you to think of your clients. Think of prospects that you have right now that fit these types of scenarios, because I think this is something you can go out and talk to them right away. So let's take, for example, policy review. We've got three scenarios that we're going to talk about here, two of them specifically related to this short-term premium. One is policy reviews. Existing term clients, maybe they've even written that term recently. Think of those types of clients. Think of people that have a low initial cash flow. So they just started a job or a career. Maybe it's a business that just started up, or they just acquired a business and they have a loan now that they're paying on to have acquired this business, so expenses are high. Maybe there's an underwriting challenge, and the underwriting risk class is that premium a little bit higher than what they can afford. So let's look at a scenario where we've gotten into the policy review. And this is a perfect scenario because a lot of agents aren't going to review this with the client. If they have a 40-year-old who's a preferred that says, yeah, I just bought a policy a couple years ago, a lot of times you're going to say, okay, great, let's look at what else you might have because you've got that covered. Well, here's why you would want to review that policy. This was a $1.2 million death benefit that was purchased in 2013. And if you look at it, this is their premium layout. This is cut and pasted from their actual policy. This is not a Protective policy, but it's $1,109 for the 20-year premium. But then look what happens in year 21. We've got that $25,000 annual renewable term, and then it goes up thereafter. Now, with all the changes that we've seen and carriers eliminating conversion privileges, eliminating guaranteed products to convert into, some carriers have stopped writing new business. So that ART, where it might not have used to have been a big issue because a lot of times the actual premium isn't renewed at the maximum that's illustrated, but a lot of these carriers that don't want that business to continue, they probably will charge that higher amount. So it's important to kind of focus on that with a client. So the remaining 17 years that they have is about $18,800. If we look at Protective's Custom Choice UL, we're going to run a 20-year term. But what we're going to do is we're going to pull the premium down in the first 17 years. And I want to emphasize that because a lot of products, most products, you cannot do that with. You run a 20-year term, you pay that 20-year premium. With ours, you can tell the system, hey, I want the premium to be a little lower than the normal 20-year. I want it to be lower for 17 years or 16 or 18 or whatever the flexibility is that you need. In this case, we're doing 17 because we're matching the remaining 17 years of their term. And if you look at the cumulative difference between the two policies, they're very close. We're within a couple of bucks a month to replace this policy. Now, this client might have purchased 3 years ago thinking conversion was a big issue. Well, this carrier specifically does not have that product anymore to convert into. So this solution that we're providing them not only gives them a better conversion privilege at a competitive price, but look what happens in year 17, or year 18 in this case. The premium will jump for the next 3 years to finish out the 20-year period, but it's only about $3,300. So it's a low enough premium to where you can say, yeah, I still need that coverage, I want to keep it. Then, after year 20, if they want to keep that premium, it'll go back to what the normal 20-year level premium would have been, which is $1,305, and that face amount will decrease each year. So the flexibility that this term solution provides is far superior to what's out on the market. The typical term on the left, they pay their premium. After that, they got to make a decision to let it go or to buy a brand new one. Ours gives them that flexibility 3 years after. If they want to keep that for the additional 3, they can keep it even longer after that for the reduced death benefit. Let's look at another scenario. A 25-year-old, this is a super preferred million, bought a policy 2 years ago. And you can see their premium was $260. Well, we just ran a new 10-year, and our 10-year term was less expensive. So this one wasn't even something you had to mess around with the premium. We could just get them that. But for a couple bucks more a month, we're able to secure a 15-year term and provide them even longer coverage. So get that into your mind to be thinking about reviewing policies with clients. We've done it with mortgages for years. Hey, let's review your mortgage. Rates have continued to decrease. Same thing has happened with term insurance. So be reviewing those policies. Let's look at a business owner scenario that we can use this same exact concept on and be thinking about your clients that own businesses. This is specifically a buy-sell case. So we've got 2 partners in a $5 million business. One of them, who's age 55, has decided he would like to sell within the next 5 years. So his portion, the $2.5 million, needs to be covered by term insurance primarily because it's an inexpensive way to fund the buy-sell agreement. But a lot of times what people will do is they'll say, let's see if we can find a 5-year term policy. Well, there are some out there, and right now the lowest one is about $8,500. Now the problem with that is if you run our 10-year level premium product, our custom choice UL, it's $7,400. So it's less expensive, which is great. However, your goal as the producer is to try and find the best possible solution for this business owner. What is the least cost that he can incur for his $2.5 million buy-sell agreement to protect him until he sells that business? Well, just like we showed you, we can actually reduce that premium to its lowest point in the first 5 years, giving him a premium of $5,800. Then in the next 5 years, it'll jump up to $9,900. So the 10-year cumulative difference, if you go with this 5-year step premium, it's about 5 to 6% more cumulative premium. But if he sells in those first 5 years, he saved 21% in his premium costs. So again, it's a differentiator for you. You can show that business owner, hey, I've got a creative solution for you that can save you money, but still provide the full 10 years if we need it. If you don't sell, great, you still have coverage, it's still a level death benefit. But the cost structure we can play with to make it as customized as possible for your specific situation. So think of your business owners. This is a great way to accommodate some flexibility. Let's talk about loan protection. And this is a good one because this product lends itself very well to showing something different to your client. Think of your clients. These are the target clients that are homeowners. You should have a lot of those. First purchases, refinances, whether they've done home improvements. Think of those types of clients. Think of business owners, new startups, and buyouts, because this works out as well with that as well. Really, any kind of loan situation. One of your clients or prospects says, I've got this loan I need to protect. Great. Protective has a great flexible solution for that. So again, we'll just reiterate a traditional term policy. At the end of the initial level period, that premium goes up and the death benefit remains the same. Ours does the opposite. Premium remains level, death benefit goes down. Why is that important? Well, it's because we're going to use that to our advantage on loan situations. So here's a typical $375,000 mortgage, 30-year for a 35-year-old. Most people would do what's on the left here, and they would just say, let's do a level 30-year term. This one's with Legal & General. Banner, great product, low cost, $428 a year. Great, nice, easy solution. However, with Protective, what we can go in and do is something a little different. We can run a 20-year custom choice UL. And what we're going to do is we're going to run it at $500,000 instead of $375,000. If you look at the premium, our premium's lower. It's only $337. Well, because it's a 20-year. Even though it's a higher death benefit, it's a 20-year policy. Well, let's look at it in a little more detail of what happens here. So for the first 20 years, the client's going to get $125,000 more benefit for a lower premium. Then, in year 20, our death benefit starts to decrease. However, if you look at it, the death benefit is still enough, even in year 25 all the way through, to cover the existing mortgage. And that's the highlighted in blue there. Now, that's why we had to increase the face amount up front. So you'll just want to make sure when you're running those numbers that the mortgage debt that they have that's decreasing is covered by the death benefit. If there's not enough death benefit in those decreasing years, just raise it a little bit on the front end. I have yet to have a client complain about having more coverage in the first 20 years at a lower cost. So it's a great solution. And if you look, the total premium, $10,110 versus the $12,000, it's a substantial savings for the client. They get more coverage in the early years. They still get enough to protect the loan in year 21 through 30, but then also in year 31, they still have coverage at that $337 premium. So if that client had refinanced, if they'd extended the terms of their loan, they still have coverage, and they don't need to worry about paying a very high annual renewable term for a year or two just to cover a very small remaining portion of their mortgage. This specific strategy was 21% less than a typical 30-year term that we just showed with Legal & General there. And it's a great talking point for the client. You can stay in touch with them. Again, they've got that first 20 years they can convert if they needed to, but it provides them a lot more flexibility than just a typical term policy. So a couple of things I want to really hit on here, sort of as the takeaways, because I think there are a lot of things that we can really take away. So number one is policy review. If you're not reviewing policies with your clients, somebody else is, and you're going to lose out on that business. So when you're talking policies written in the last 5 years, don't ignore those. Talk to your clients. Hey, have you taken out term insurance in the last 5 years? The great part about doing it recently is they haven't undergone a significant age change, and generally they haven't undergone a significant health change. So for you to come in and show them some better alternatives, pricing is still at that part with the flexibility where it's very comparable. Might even be a little less expensive. Again, you reduce the premium in the equivalent years to match the remaining coverage. And it's really easy to do. Tom and his team can show you how to do that on the software. You can do it in WinFlex. You can use our software, however you want to do it. But it's a really easy step to do that. And again, you're improving the conversion options. A lot of the big name term carriers don't have as competitive conversion privilege as they used to. So if you've sold a previous term case with the idea of converting it, you might want to revisit those policies and talk to the client and say, okay, let's talk about what's available now with this policy, and there might not be a lot. So replacing that business might be a very important piece to their continued coverage down the road. Think of your business owners. Think of business owners with newly acquired debt, and really works handy for those business owners that are startups, because they have a lot of expenses and not a lot of income coming in. We've done this with doctors, with chiropractors, dentists that have to buy a business. They have a loan. They have to insure that loan. The bank requires them to. So why not come in and show them a less expensive way? Lower it in the first 5 years. Make it easier for them to pay their bills. And then as their practice establishes, their premium will go up a little bit and then still remains that level coverage for 10 years. Business equipment loans. A lot of your business owners that buy large equipment, a lot of times they need to secure those loans with insurance. This is a great way to do that for them. And again, like we talked about the buy-sell scenarios. Now, the one we talked about was because he's selling in 5 years. But think about scenarios where there might be an inequity in health between the two partners, and you maybe need to get that premium a little bit closer because the one business owner might be 2 years out from a surgery, so he has a flat extra right now, or he's 3 or 4 years out from a certain condition that needs to clear for him to get a better health rating. Well, this is a great way to pull the premium down in those earlier years to help compensate for that. And again, loan protection. So think of all of the clients and the prospects that you have that have loans. Most of them are going to have them. So this lead pool is large. It's not something you're going to have to go out and market to and try to build new prospects. They all have mortgages or they all have business loans of some sort. And as we mentioned, the startups, the doctors, the dentists, the chiropractors. So those are 3 very specific things that you can do today to go through your prospects, go through the clients that you have, review policies that they have on the books, existing term policies, even if they've been written recently. Your business owners, there are a lot of things that people are not talking about with business owners. And this product, Custom Choice UL, is a very flexible term solution that is customizable and provides a lot of flexibility for you to work through whatever problems that your clients might have, whatever objections they might have or concerns. There's a lot of flexibility built in here to do those things. So I know that seems like it's a lot of information, but I tried to boil it down as best as I could to 3 specific things that you can do. And so what I'm going to do now, I'm going to turn it back over to Tom. And as Tom mentioned, we don't have a lot of time, so if you've typed in some questions, that's great. We'll go ahead and we'll circle back with you on those questions. I know Tom and his team are going to get out some specific marketing pieces that we have that address each of these scenarios that we've talked about so that you can have them as reference. And again, Tom and his team, they're great as far as helping work through cases, live cases. If you've got some scenarios that you say, well, maybe that idea for the business owner would work with this one. Great, talk it through, get some illustrations and actually see how it works. The best way for you to see how this works is to run some scenarios on yourself. Look at your own coverage, look at coverage if you have a business succession plan and you've got something like that in place, run them on yourself. That's usually when it sinks in the best. So hopefully there's been some good information here today. I think there are a lot of sales opportunities for you going forward in the next 2 weeks that you can work on here. This product is submitted. You can submit it electronically, which takes time away from out of your hands to not have to fill out the application. We have our tele-life process and drop tickets. So great scenarios to be able to do that with. So Tom, I'll go ahead and turn it back over to you if you want to wrap it up and if you have any additional feedback.
Sounds good. No, Dan, I appreciate it. I want to thank you again. I want to thank everyone for joining us today. Hopefully, you were able to come up with a few clients in mind as Dan was describing the sales ideas and giving you those sales ideas. We are committed to, when we host calls like these, we want to give you actionable things that you can implement into your business. Our goal is to help give you jumpstart ideas to go back and close more business, generate ideas. So hopefully you came away with those today. I think Dan did a terrific job, so thank you again. Our sales team at Insurance Network will be following up with you within the next day to see if you have any questions. We got some additional action pieces that will help you that we want to get into your hands. But if you need them sooner, And if you have someone specific in mind, please don't wait. Give us a call right away if you want to talk about a specific case. We can help you with some case design and give you everything you need to put you in the best light with your client. Give us an opportunity to earn your business if you're not contracted with us today. Again, our number is 800-456-7999. I know many of you know it, and I said it at the beginning, but please give us the opportunity and find out why we are different. We have the contracts. We have partnerships with Dan Hudgens and Protective Life, and you know, is one of our premier carriers. So I want to thank you, Dan, for making the time today. Thank you, everyone, for joining us, and have a terrific day. Thank you so much.